And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Hello and welcome to the show. This is Andy Webb with Lifestyles Unlimited. And as always, we're working on your financial freedom. And I thank you for tuning in today. I've got a great show for you, and I bet you're going to have a lot of questions after today's show. Today's topics usually cause you to send me a couple emails, and if you do have any questions, you can send those my way to askandy@luinc.com, askandy@luinc.com. We had a big milestone, a big finish line, I guess, that we all crossed, hopefully, just this past week. If you made it, did you make it to the finish line? Did you finish the big race on April 15th? I failed. I did not get to the finish line. I mean, tax day, right? April 15th. Did you get your filing in? I was missing one document for my CPA to complete the whole thing. I just couldn't get it. Just could not get it in my hand. So let my CPA know on Friday, hey, doesn't look like we're going to get the document. Fortunately, she said, hey, don't worry, I extended 2 weeks ago. I was like, what? Okay. First thing I did, by the way, when I became a real estate investor was hire a CPA, outsource the taxes. And it's things like that that make me really celebrate the fact that I didn't. More good news that she had for me, aside from having, we went ahead and extended for you. She said, you don't owe any taxes. In fact, you're going to get some money back. Wow. And that is in spite of making a huge gain on the sale of one of our rental houses just last year. Huge gain. And that is thanks to the tax advantages of being a real estate investor. So if you have any of the residual, let's say, tax day blues, let's talk about some of the benefits of investing in residential real estate from the tax perspective. But I'm going to speak more broadly as well to the benefits in general of real estate investing, including those tax benefits. But there are many others that I want you to understand. And I'm going to hit some listener questions during the course of the show because a lot play into some of the topics that we're going to have today. There are a lot of benefits, and you may not be aware of these, and I want to make you aware of these. And I mentioned in the earlier segment that we sold one of our rental houses last year. So for last year's tax filing, that appeared on the filing with my CPA, and the gains were somewhere north of $150K. It was pretty substantial. We brought home even more cash than that, of course, but the gains were there. And the question became, well, are we going to pay taxes on that? By the way, similar situation the year before. We were passive investors in an apartment that also sold. 100% return. The money we put in, we got out, plus that exact amount. I mean, we doubled our money. That year, guess what? No taxes owed. So how are we doing that? There are two primary tools in this case, in these situations, that investors will deploy to offset those gains. I'm going to talk about the one we used to offset the house gains, first of all, and those apartment gains, and those are passive losses. So the IRS does view investing in real estate as a passive activity, and those gains that you make are considered passive gains, whereas when you're working, that's an earned income. Right? That's earned income. This is passive income. And we do have passive losses. Now, these are paper losses, and these are due to depreciation. When you buy a house, a rental house, and the IRS views that as having a shelf life of 27.5 years. So whatever that purchase price was minus the land, they're going to tell you to depreciate that or write off a portion of that house every year for 27 and a half years. Okay, well, that depreciation already as it stands plays into our benefits on the cash flow side. I'm going to leave that to the side for now. But we do accrue these losses. And the real power comes when you do two things. When you buy a single family house that you renovate, well, a lot of those renovation costs are viewed as expenses now. You don't necessarily depreciate those. You're able to write those off. And some of that gets built into the depreciation as well and hits that Schedule E that you file. Bottom line, those start to build. They start to accrue. Any wins you have on the passive side with your houses get offset by that depreciation. But it gets even better. It gets even better. That 27 and a half years, that's for the sticks and bricks. But if you think about your house, right, where I'm sitting right now, I'm doing the show from my house. I've got carpet, I've got sheetrock, I've got doorknobs, I've got light fixtures, I've got a fence outside. These things all have a different shelf life than the sticks and bricks in the house itself. Carpet is 5 years. AC might be 10 years. I don't know off the top of my head, but it's somewhere in that range. So if you took your house apart and looked at each individual piece, you could accelerate some piece. You could shorten the depreciation life on each of those individual items, and we do that. We do that especially when we invest in apartments. The apartment lead, I mentioned that a moment ago, the syndicator, they'll go out and get what is called a cost segregation study. And basically, they're taking that thing apart and they're taking it down to all the banisters, all the handrails, everything we talked about, light fixtures, etc. And they're able to accelerate that depreciation. And the really cool thing is a couple of years ago, we were able to use what's called bonus depreciation, which allows us to take 100% of that accelerated depreciation in year one. That was part of the President Trump's tax package years ago. That has started to phase out. It went from 100% to 80%. This year, 2023, it would be 60%. But regardless, we're accelerating depreciation. And what that means is every time you invest in an apartment community, if that syndicator, if that lead says, hey, I'm going to do a cost segregation, know that you're going to be pulling a lot of that life of that depreciation forward. Paper losses. And all of these paper losses that we've accrued both through investing and renovating houses, as well as the depreciation that we're getting from our apartment investments, that fully went against our apartment sale 2 years ago, fully went against the sale of our house last year, to where we owe no taxes. We owe no taxes. And by the way, that accelerated, that bonus depreciation, that is scheduled to phase out over a number of years. Like I said, started at 100, went to 80, now it's at 60. There is debate right now on Capitol Hill to resume that, to take that back to 100% bonus depreciation for, if it passes, for the tax years 2023, so the one that we're talking about, plus 2024, plus 2025. So if you have a lot of passive gains that you want to offset, selling a house, selling whatever, this is something to consider, because these passive losses can fully be deployed against those passive gains. Yeah, but I'm working a W-2 job, Andy. I have earned income. How does that help me? Well, it does, two ways. Number one, if you are working and you do have earned income, you are allowed to use a certain dollar number of your passive losses, even against your earned income, up to $25,000 in losses, up to a certain income. Here I would encourage you to talk with your CPA or send me a question if you want to, but it is limited in your use. When we first started, my wife and I, we fully deployed this option as well because we were not high earners, right? Our income was below that threshold, so we were able to use that $25K in passive losses against our earned income and reduce that tax burden. Now, if you say, well, I'm a really high earner, I can't use that, I'm above the threshold. Okay. Yeah, well, if you have somebody in your family that has the time and can become and devote their time to becoming a real estate professional, that allows you to use all of your passive losses against earned income. So then there is no threshold. So say someone in your family is a doctor earning very high income and you're a stay-at-home dad like I am, you can become the real estate professional and devote all those losses, those paper losses, to offsetting that earned income. Huge benefits, huge tax benefits. Now, it doesn't stop there. I mentioned that using the passive losses, that's just one of two tools that real estate investors will deploy to offset those gains. The other one is called the 1031 exchange. I know a lot of people out there have heard about this. There are nuances to this, but in a nutshell, and I'm not the expert, I am not a 1031 exchange agent. You do have to use one if you deploy this strategy, but basically what you're doing on the sale of an income property, you're rolling the capital gains plus any depreciation recapture plus any self-employment taxes plus any state income taxes. If you live in a state, I'm in Texas, we don't have state income taxes, but if you live in a state with state income taxes, you can roll all of those taxes as part of the sale of that property into the purchase of your next replacement investment property. taxes are still owed sometime in the future, but you're deferring those now. Instead of having to give up 20, 30, whatever the percentage is to the government and lose that, you're now able to reinvest that, and your money continues to grow. You continue to cash flow. You continue to make equity gains using the 1031 exchange. I did not do that on mine. We didn't need to. We had so many passive losses. I need the money. I wanted it out for something else. Depends on your goals, right? Which tactic, which strategy do you take? It depends on your goals. But hey, the good news does not stop there. We have even more tax advantages and more advantages and benefits beyond that. We'll talk about those when we come back.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
Lifestyles Unlimited wants you real estate retired. Learn the roadmap to wealth building. Impact your family for generations. Just like Lifestyle members Chad and Lisa.
Our kids are actually involved, and so they're learning the ropes. They see this in their future. It's benefited our children in the way they think of their future. It's taught them how to think in the millions.
Learn from the best. Lifestyles Unlimited, teaching you how to retire in 5 years or less while building generational wealth. In this rapidly changing environment, now's the time to take action. Go to GiveMeTotalFreedom.com. Enter code 2024 for a $297 2-year membership. GiveMeTotalFreedom.com. That's GiveMeTotalFreedom.com. Enter code 2024 for our Financial Freedom Program membership special. $297 for 2 years. That's 66% off our regular price. With over 33 years of educating and mentoring experience, let Lifestyles Unlimited help you become real estate retired. Go to GiveMeTotalFreedom.com.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the show. I'm your host, Andy Webb, and thanks again for tuning in today. If you have any questions, send those over to me. You can email me at askandy@luinc.com. Again, we're talking IRS taxes today. So we talked about some of the tools we use as investors. That's deploying those passive losses, which are paper losses, against active or against passive income. And we also talked about the 1031 exchange very briefly. Very briefly. That might be a whole show that we can get to later in the month or in the year. But that is a great tool if you continue to reinvest those funds from the sale of that property. Do that 1031 so you don't pay the taxes. Those taxes go to work for you in acquiring another or maybe even 2 or 3 properties as a result of that sale. But the benefits on the tax side continue. We mentioned depreciation. And when I think about one of our targets as investors, we're trying to create cash flow. And my net cash flow on a single family house might be anywhere from $200 to maybe $500 or $600. It depends on the market, depends on the property, depends on your credit and what sort of an interest rate that you're getting. But that $200 to $500, $600, that's before I go and file my taxes and calculate in the depreciation. And those depreciation, those paper losses that the IRS wants me to take, they typically offset that cash flow. To the point, I mean, we had a banner year last year with our rental houses from a cash flow perspective. No taxes. This is where depreciation plays into this as well. If you're doing it right, you'll owe little to no taxes on that cash flow on those rental properties. Good advantage. That's something that we see ongoing, right? The prior topics, that's when we sell. That's when we have those disposition events. Now, one other benefit I want you to think about, and this came from a listener question. He's been thinking about this. He asked me about 1031 exchanges. We had some back and forth, but ultimately I could see where he's going with this. He's got a grandson, and that's who's in his mind. That grandson, these properties that I'm going to accrue, or this portfolio that I'm putting together, at some point will go to that heir. How are taxes handled when I pass away and my properties go to my grandson, or in my case, to my son? This is really cool. This is a really cool part of real estate investing. The benchmark resets. Even though you might have bought that house for, let's say, $100,000 10 years ago, and it's now appreciated to $300,000, and these numbers we've seen these in the past decade. When you pass away and that house goes to your grandson, they reevaluate the benchmark for the capital gains calculation at that current market value at the time that you pass. So they now value that at $300,000. So if your grandson turns around and sells it for $300,000, there are no gains. That's called stepped up basis. Very, very powerful in your heirship planning. Now be aware there are parties out there within our government that would like to get rid of that. They would like to get rid of that. Do some digging, figure out who that is, figure out if that informs who you want to vote for in future elections. But stepped up basis is a very, very powerful consideration, a very, very powerful way to make sure that your heirs are getting away from those taxes. Okay. So, hey, if taxes, April 15th has come and gone, if they've got you down, take a really hard look, a really good look at real estate investing. It's very passive, has a lot of benefits on the tax side. Oh, and by the way, thinking about tax advantages, I know a lot of you out there are investing, let's say that's what you use in your brain, in a 401k. What are the benefits, thinking about taxes, what are the benefits of a 401k? Well, couldn't you, if you have a higher tax bill than you liked at this April 15th deadline, couldn't you increase your contributions to that 401k to lower your tax liability from your earned income? That's what the 401k does, right? The more I pay in, the less my earned income shows on my W-2, therefore the lower my taxes. It's a tax-advantaged savings account, in essence. That is the advantage of the 401k, the tax advantage in the moment. But it is a tax advantage. However, you're not deferring those ad infinitum. You do get taxed later on when you withdraw the money. You've probably heard, I'm in my 40s. I'm in my 50s now. Stop. You probably heard once you get to a certain age, you're required to pull money out. That's a required minimum distribution. Yes, the government will make you withdraw your funds so they can tax you. The government is going to take its pound of flesh. So that tax advantage is an advantage in the moment, but be careful with that. But worse than that is the fact that as you put your money into that 401k, and I'm just focused on this because it does offer some tax advantages in the moment, but the problem is you're limited, for one thing, in your investment options. It's a handful of mutual funds, perhaps, whatever your employer has selected. You have no control once you give up those funds. You have no cash flow. That does not come back to your pocket. You have no big equity capture when you buy, right? When that 400, 500, whatever the number is, comes out of your paycheck, goes into the 401k, you're buying at market rates. You're buying at market values. There is no immediate gain when you buy. You know what? Those sound like some of the other benefits of investing in real estate. Control, cash flow, big, big, big equity capture when you buy. How do we get it? Well, we get it by investing in single-family houses and in apartments in multifamily. I mentioned already, cash flow from a house, my net cash flow, my net profit, the money that I'm keeping every month from one house. It can be anywhere from $200 to maybe $600 a month, dependent on the market. We invest across the nation, by the way. We have realty teams in many states, primarily across the Sun Belt, the southern part of the U.S. That's where investing makes sense right now. But $200 to $600, now that's not going to retire you. But you'll figure out by buying and rehabbing and renting one house that it's very, very easy to do. Another benefit of real estate is that the process is very repeatable. So you do one house, it's very easy to do another and another after that, until you reach the point where you have $5,000 coming in every month or $10,000 coming in every month. And if you're trying to replace your earned income from a job or just match your outgoing household expenses, you can get there quicker than you might think and become retired. Another benefit is just that cash flow. So cash flow from houses. Apartments are a bit different. They pay quarterly distributions typically. I do know one apartment investor that pays monthly. Hey, all right, his business, he's going to run the show that way. But primarily, they're going to pay every quarter. It depends on the business plan. I just looking back the past couple of weeks, I got 4 distributions from 4 investments doing nothing. These are purely passive investments in apartments. figure out if I like the lead investor, figure out if I like the investment opportunity, figure out if it meets my goals, my return goals, the location where I want to invest. And if it does, put in the money and sit back. Read the reports as they come available, the financials, and look at the distributions. I'll tell you, my main cash flow as an investor, as a retired guy now, is from my houses. That's where the bulk of it has been built up over the past decade. Plus, the apartment distributions, that's just a bonus. That's just bonus cash flow. Hey, Jenny, my wife, what do you want to do? Look at this, just came in. Go take a trip? What do you want to do? So a lot of advantages there from the cash flow perspective. And going back to the tax advantages, we do protect that cash flow thanks to something called depreciation. If you're doing it right, you will have low to no taxes on that cash flow. And thinking about cash flow, I had a listener question. He said he's having some trouble penciling out the math, the numbers on single-family houses. This gentleman is in Texas, and just with interest rates where they are, and becoming cash flow positive. And again, single family. And I asked him a few questions. He's not invested yet. He did the right thing. He's got the education. He's a member of Lifestyles Unlimited, got the education, became pre-approved with a lender, got a rate quote. Now the rate quote was really high. It was really high. It was close to 10%. I thought, that's pretty high. I don't know. Maybe he was talking about hard money. Typically, we're buying a house with hard money, fixing it up, and then refinancing it into longer-term debt at a much lower interest rate. Now, those interest rates, those mortgage rates have gone up, again, thanks to the Fed and thanks to their outlook, which has now changed. But you should be somewhere much under that. I don't know if he was looking at hard money. If you're looking at buying a house with hard money, which is going to be a higher rate, but a short-term loan, do not use that in calculating your cash flow, because you're going to go in, you're going to do the renovations, you're going to get back out into that lower term debt. So I encouraged him, and I encourage you as well. If you're getting a rate quote and it seems a little bit on the high side, shop around. There are a lot of lenders out there, a lot of mortgage brokers that would be happy to talk with you. They're not doing as much business right now because of where rates are. So take some time and talk with everybody and get a couple of options. Ask, hey, why was this coming in at close to 10%? What's going on here? Right. Could have been the credit score, could have been the property itself, or maybe we're thinking about borrowing too much. It depends on the size of the mortgage, the property type, etc. And if you need to, you can buy down the rate. I've done a couple of DSCR, that's a type of commercial loan. I've done a couple of DSCR refinances, and I've bought the rate down to 6.5% because this is on properties that I plan to hold for a little bit longer. So buy down that rate if you need to, right? There's a point at which it makes sense to buy that down, but I was able to buy mine down to, 6.5%. Right? So I'm cash flow positive. I'm cashing out of the property. I'm pulling that equity out and able to reinvest. And that takes me to one other big benefit of real estate, and that's the equity side of things. And we talk a lot about cash flow, and we talk a lot about equity capture. I want to define this and make sure you understand what that is, because it's a huge, very, very important number. Again, if you're buying right, if you're following the right model like we follow at Lifestyles Unlimited, you're finding distressed houses, and because they're distressed and they do need work, typically, you're able to get them at a discount. So you may buy a single-family house for $100,000, but it needs work, and it needs $50,000 worth of work. That's okay. That's not a huge number. Sounds big, maybe if you've never done it before, but that's reasonable. For all cosmetic, maybe fixing the foundation, putting a roof on, maybe a new AC. So we do the work, purchase for $150 in work. When I'm done, the value is $200,000. That gap between $200 and $150, that's the equity. That's equity that I've created through the process. And that's equity capture. Now, I will have some cash into the investment. Maybe it's $20K. My equity capture is $30, but that's 150% return right there. Right? That's unrealized capital gain. But here's the cool thing. We're going to sit on this for a couple of years because we are renting it out. We're making that cash flow. We're enjoying the tax advantages, not paying any taxes on that cash flow. And as we're sitting on that, and our renter, what are they doing every month? They're paying us rent. We're paying the mortgage. They're paying the mortgage on our behalf. So our principal goes down, our equity goes up. And at the same time, we see appreciation. And it's interesting. I'm not going to go into details here. I picked up an article just last week. U.S. home builder sentiment stalls as buyers wait for rate drops. There's not much buyer activity out there. There's not much seller activity out there. And at some point, those rates are going to drop and the demand's going to pick up. And I think those values, those prices will go up. Will they skyrocket? Will they go up 5%? Will they go up 10%? I don't know. But I think it's going to happen. And if you're sitting on assets now, you're going to enjoy that appreciation, which is, again, just another equity play that helps you build wealth. So we create the equity through equity capture at the outset. And then we enjoy the equity buildup as our resident pays down the mortgage, and we enjoy the appreciation, right? Especially in an inflationary environment as values go up. But going back to that cash flow, going back to that DSCR cash out refinance, maybe at some point I want to pull some of that cash out. I could sell the house. We did that last year, right? Got the cash out. Or I could do a cash out refinance. That is not a taxable event. You're just resetting the debt. So another big benefit to real estate, you can create this equity and tap into it tax-free. Now, a listener did ask me another question, asked how much cash can I pull out when doing a refinance into conventional debt out of hard money? Here you need to understand the process and how loans typically work. If you want to do a cash out refinance, normally the loan needs to season for 6 months. And that just means you need to be in that loan for 6 months, whether it's conventional or I confirmed with my DSCR lender, yes, seasoning is required there as well to the tune of 6 months. What that means is if I buy with hard money, I want to get in and out of that quickly because it's a high interest rate loan. So I'm typically doing a rate and term refinance and getting out after maybe 2 months. If you want to wait and do a cash out refinance, you just need to plan to sit in that hard money loan for a little bit longer. Now, you can pull up to $2,000 out, $2,000 if you do a rate and term, but if you have a really, really big equity spread, and you're typically going to get that from a bigger repair job, well, maybe you wait. I know a few investors at Lifestyles that have done that, sat on those loans, those hard money loans, so that they can do that cash out refinance after 6 months. But ultimately, we're going to tap into that equity by doing a cash out refinance or doing a sale. Cash out refinance, again, tax-free. If you do the sale, go back to the earlier part of the show where we talked about the tax advantages and leverage those to defer your taxes or avoid or offset them with your passive losses. Huge benefits, right? Tax advantages, cash flow, equity capture, equity buildup, appreciation, and that doesn't even get into some of the intangibles like the fact that I take control of my money, my time, become real estate retired. In 5 years or less, you can do it. Thousands of members at Lifestyles have done it too. Check us out at lifestylesunlimited.com. And remember, it's not the money, it's the lifestyle. You have a great day.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.